Welcome to this Killick Explains video. This time around I want to deal with a request I've had in by email from a few people to just demystify some of the jargon around share trading. Now, just to stress, I'm not a big believer in regular share trading, timing the market and so on, but there's no doubt about it, you've got to start somewhere. So if you get a recommendation to do something, buy a share, hold a share, sell a share, what is some of the jargon around that and how do you interpret it? Now, the background to this is what then? Well, apart from a few requests for me to deal with this specific topic. So the city loves to use jargon. We know that financial markets, things are getting better than they used to be, one could argue, but there's still a lot of jargon around. And the act of describing the attractiveness of a share is no exception. Believe it or not, there are quite a few different ways to do it. I want to cover off some of the big ones. So here's a short guide to some of the words you may come across in your travels and scratch your head wondering what it means. And these are words you'll come across on websites, you'll come across them on research reports, and sometimes you'll come across them in the media if you're reading the FT or that kind of thing. So, 3 words, first of all, hopefully we all know well and understand the meaning of, and then a few variations on that theme. So, buy, hold, sell. Now you might think, well, that's pretty clear. All right, someone says to me, you should buy this stock, Tim. Fine, okay, pretty much understand what's going on there. Buy on the dips. Hold means exactly that. Don't add to your position, don't sell any shares at the moment, and sell means as it suggests on the right hand side. And you might think, well, that's pretty clear, why do you need a video on this? And the answer is, there are some subtle ways of saying the same thing a different way. So I just want to cover those now. Variation number 1 on that basic theme is positive. So you might find that an analyst has written a report on a stock and says, we are positive about this particular share. And that just means we like the look of it and presumably we think it's reasonable value right now. And that can be expressed as a view or a rating. Okay? And the middle one then is neutral, which I guess makes sense. So we're kind of not changing our view at the moment on this particular stock. And then of course, negative. And as the facts change, you'll find research reports can swing from one to the other and go through graduations. So negative to neutral to positive, or in an extreme case, you may get someone going from that side to the other, albeit that would suggest the facts have changed quite dramatically, I would suggest. Variation number 2 is what? Well, this time overweight, which translates roughly as we like it and it ought to do quite well. Equal weight or neutral is, roughly speaking, imagine someone's running a portfolio for you, let's say, or is talking to you about your portfolio. We hold what we think is about the right amount of this stock, okay, versus what? Well, usually it's versus an index or even a target range. Usually an index, I'll come back to that in just a moment. Underweight, we're less keen and are thinking of or have reduced our holding accordingly. So that's another bit of jargon. Overweight, equal weight, neutral, underweight. Now just to come back to more precisely what that actually means, how you interpret those words, the normal use is a benchmark comparison. So let's say a benchmark index contains 15% technology shares. Let's say it's the MSCI Global Index, and I've made up the number, I think it's a bit higher than that at the moment, 15% technology. All right? And essentially, a fund that holds just 10% could say is underweight technology. In other words, relative to what you'd expect to hold were you simply tracking the index or benchmark, we're in a position where we're holding fewer stocks or recommending fewer stocks. And this can apply, by the way, to a basket, a portfolio, or an individual stock where an analyst says we are underweight or overweight. And a fund that holds 20% relative to that, remember, you could say therefore it's overweight. So usually it's versus something, typically an index. There is another refinement, I'll just mention it. That's the usual use of overweight, underweight, and it's this, a possible twist I've called it, and that is that a fund may have a target range for, say, technology shares. So a fund manager may have sat down and said, well, actually, we basically want a certain percentage, but we've got a variance where we could be a little bit up or a little bit down. So it could be that basically this fund would normally sit on 15% of your money will be in those technology stocks, if you like, but with an allowable variance of plus or minus 3%. And in that case, you might get the language being used here. So in other words, 18% would be as far as they can go. That's 15 plus 3. That makes them technically overweight by their own definition, if you like. 12%, 15 minus 3, will be underweight. So usually it's a reference to a fairly standardized index or benchmark of some sort, but it can also slip in where a fund manager is talking about their own sort of variance around a particular number. Okay, variation 3. And you may be wondering how many there are. You're almost there now. So variation 3 is oversold, fair value, and overbought. And this is where, say, someone's looking at a share and saying, well, oversold tends to mean the market basically has got ahead of itself. Markets are exuberant. In other words, they overcook things on the downside when everyone's pessimistic and selling, and they overcook things on the upside when everyone's enthusiastic and piling in and buying to the next hot ticket. So oversold, we tend to say, well, that suggests it's kind of cheap versus the fundamentals. Now, what those fundamentals are may vary from investment house to investment house, but basically the market's got ahead of itself. Fair value is, put simply, using a discounted cash flow model or something similar, we think the share price is about right at the moment, and overbought, it's looking a bit punchy versus the fundamentals. And how can that happen? Well, momentum can carry a stock above its kind of implied fair value, if you like, as an analyst might see it. So, oversold shares are usually expected to bounce, is the point. In the short term, fair value stocks are expected to stay put, and overbought shares may pull back or correct, to give you a bit more jargon. And so what if you've got a portfolio? Well, it may be that there's an opportunity potentially to top up, to get to a weighting that you're comfortable with, if that's about to happen. And it may be that, if you're already overweight, it may be that there's an opportunity potentially to do something about it, to adjust. There you have it. Lots of jargon, lots of ways of saying the same thing, you might argue. Editor@killick.com with any questions. And if you're wondering about some of the other aspects of shares in general, then it's killick.com/learn, and you'll find sort of over here there's a shares tab.